Hello, in this presentation, we will take a look at financial statements within our bookkeeping problem in Excel, keeping in mind how that same information might be input into accounting software such as QuickBooks. We're first going to take a quick look at QuickBooks and then go look at the financial statements within Excel. Financial statements can be generated within QuickBooks fairly easily, and QuickBooks can really put that information together in a format and different formats in a quick and easy way. We're looking here at the financial statements, and all we need to do is generate the report and put the point in time, that date, in order to get this information, the balance sheet as of a point in time, and the components of assets, liabilities, equity as part of the balance sheet. It's also possible to customize the balance sheet and rearrange the numbers in a lot of different ways within the QuickBooks system once we have that data input. For example, we could easily manipulate the data to get 3 months of or 2 months of information and a comparison by using the customized report field. These are types of things that are a lot more difficult to do in something like Excel and very difficult to do by paper and pencil. These are the benefits of the automation. This is the benefit of having the data be able to be put in systematic ways using systematic rules so that the computer can just put those together. We're looking at some of those systematic rules within Excel as we generate the financial statements automatically as we're entering data. Of course, a more sophisticated system can manipulate that data in a multiple variables of way depending on different rules, including, in this case, having both months compared to each other and just taking the difference of those two. We can do a similar thing within QuickBooks with the profit and loss or income statement, taking a standard income statement which has the revenue and expenses and making a comparison between 2 months and showing the change. These are types of variations within the income statement that QuickBooks once again can do once they have that data input. We're showing that data being able to automatically generate financial statements in a standard format within Excel. But once it's in QuickBooks, it's important to be able to understand what QuickBooks can do with that, what types of stuff are going to be automated, what types of information can be generated from that same amount of data by just setting in a system of rules to come up with different reports. And of course, the profit and loss is one of those things that once the data has been input can be generated automatically, and we can have a comparison between 2 months, and we can clearly get a change and a percentage change. Let's take a look at these reports in Excel. As we've seen as we've gone, the financial statements have been generated from the trial balance, which has been generated from the general ledger. And it's important to note what can be automated and what cannot be automated. We're basically able to see more of the automated process here within a worksheet like this, meaning we're able to see that once we create the journal entry, we can then post that. And once we have that information, we can make the rest of the process pretty much automated, meaning the trial balance has been generated in itself, as has the financial statements. That gives us an idea of what types of things the software can do in terms of accounting software like QuickBooks in an automated process, and what kind of things it can't do automatic, and what types of inputs it needs, in our case, the terms of the journal entries, in order to set that process in motion for it to be able to create what it can create. So what we're doing, of course, is I'm just going to point this trial balance over to the financials and just the cash account, just to get an idea of this, of course, and then I'm going to scroll over to the financials and we'll just take a look at those financials one more time. Scroll into the financials. Here we have the financial statements, and we can see that this information is just being pulled over from the trial balance. That, once we have the data input, is how, in essence, accounting software will generate the information. It's a set of rules saying we want to pull this into this account here, and we can just automate that process. And we need to know, of course, that process so that when something goes wrong with it, we can see where in the system could have something going wrong in order to generate the wrong amount of data. So we see this generated automatically. We've got the assets, we've got the current assets, and the groups within the current assets. We're breaking that out to total current assets, and then property, plant, and equipment, and total assets. We'll actually generate these or make these and see how they're built soon, but this is just to show the automatic process. And then we've got, of course, the liabilities pulling over automatically just from the trial balance, and that gives us the total liabilities and equity. We then have the income statement down here, and of course this information, revenue and expenses, also pulling over from the trial balance, and Note that this income statement is just for 1 month of operations, and it's a little bit more difficult in a system like this to just change the date range, meaning it's a little more difficult for me to jump from here to having 2 months of information as we can do in QuickBooks. That's one of the big benefits of the automated system, is that we could just basically say, okay, now I want to pull revenue not just from 1 month, but from 2 months. And we can more easily sort the data in a database program such as QuickBooks to pull up that kind of information. But once again, we need to know what happens when we start messing with the date ranges and changing those date ranges. And in order to do that, we need to know how it's being built up. How are these things being built? So this is going to be the income statement for 1 month. We've got the revenue, and then we've got the cost of goods sold. Gross profit minus all of the expenses gives us, of course, net income. And then we have the statement of equity, once again, generated automatically once again for the second month of operations, having first the beginning balance and then the change, net income here, and we have the ending balance. So all this stuff is being generated automatically. We'll show how we're putting that together in a future presentation related to the trial balance. Once we have the trial balance, we can set up this information to automatically pull over. We'll see what that process is. Remember, as we do this, it all must tie out, meaning that the net income will also be on the income statement and the statement of equity. The ending statement of equity will also be a number that is included on the balance sheet.